Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And guys, with that, in this episode, I'm inviting back my great friend and also the co-founder of Sunrise Capital Investors, Brian Spear. He's going to join me here on the show today, and we're going to have some fun together. So, Brian, how you doing today?
Come on, man. Life is good, Kev. This is the good time of year down here in Florida, as you well know, right? We're kind of first week in November. Well, second week in November now, but I mean, this is the good stuff.
Yeah, I agree.
How about yourself? How are you doing? 72 hours to Key West just wrapped up. How are your legs feeling after the bike ride, buddy?
My legs are good, man. Yeah, it was a successful event. I always say every year I'm not really trained up for it, but just got to use that mental fortitude to push through it. And we did just fine. We had a record fundraising year, which is awesome. We limit, as you know, you've ridden the ride a couple of years, and we limit the size of the event. We just get great people, get great participants that come. And so, we blew past our fundraise targeted goal, and which is always great because we get to help a ton of families, tons of children in the in the local area. And so it was a success overall. Everyone made it, everyone survived. No big challenges outside of maybe a little bit of wind. So it was good, man. My legs are feeling good. I've ridden a couple times this week already. So I was joking with my wife Joanna this morning that from last Thursday till today, we're recording this here on a Thursday, I've put in about 400 miles. So it's been a good week.
No big deal. No big deal. Only 400 miles this
No
week.
big deal. That's not a normal. That's not a normal week. So I don't want to overly impress everyone as you listen to this. That is definitely not normal. So, but the legs are feeling it. But I'm feeling good now. So I'll try to keep up with a more consistent routine. But you know how it goes. Life gets in the way. Kids get in the way, and we try to juggle a bunch of different balls in the air. But buddy, I'm excited to have you back. I know we do this on occasion. Always say that we need to do it more often. Well, we're here now, so that's all that matters. But I thought it'd be fun to, we were kind of chatting a little bit about just reflecting back on 2023 and what a great run that we've had. We just wrapped up SCI Growth and Income Fund 3. Outside of that, we've dealt with some craziness in the marketplace, right? Like the world is a very different place today than what it was a year and a half ago. I mean, the massive volatility with interest rate hikes for the last year plus, and transactional volume down to all-time lows. And it's just been a unique year, but I feel like we've been able to actually really close it out with a bang. So we've had some great success wrapping up our third fund, and just excited for the launch of our next one, which is coming down the pike here just in a couple of weeks. And so with that, again, just want to reflect on some of the wins that we've had, and use this as use this time together as an open forum just to talk a little bit more about the year, kind of our overall investment philosophy, and just more so about maybe what the future holds, right? Because I think you and I both agree that there's some really exciting opportunities. I'm not going to be the doom and gloomer and say like the sky is falling and there's going to be massive distress out in the marketplace. But as everyone knows, I mean, everyone's been able to read the headlines, and you might even, you yourself, you might find yourself in a bind. Maybe you're in a passive investment or something to where, distributions have paused or there's been capital calls, right? There's a lot of challenges out in the marketplace now, but I do feel, although the sky is not falling, I do feel that there's going to be some great opportunities coming our way. In fact, just to speak to that, again, we closed out some great assets in Fund 3 here just a couple months ago, but case in point of great opportunities. We literally and we can go into more detail later on the show, but I mean, I'll drop a little nugget here just to get you guys excited. And I'm not saying I don't want to talk about this deal to brag about what we're doing. This is more of like, hey guys, get ready, because there's going to be a good time to buy, and that time is now, and will be probably for many months in the future. But we just ultimately tied up a phenomenal mobile home park, institutional grade mobile home park, in a great MSA, 738 spaces. There's not even that many mobile home parks in the U.S. that are 500 plus spaces. This is a 738 space institutional quality mobile home park. But the cherry on top of this whole thing is that literally we're buying it. It just appraised for $5.4 million more than what we're paying for it. Okay. And that's a recent appraisal. That's not a appraisal that was done last year or a year and a half ago when times are very different. That's a recent appraisal using a realistic cap rate. And so just incredibly excited about that deal. We'll give you more details here in a few moments or later on the show, but just know that there's other opportunities like that coming down the pike, and you guys need to be aware of that. And that's what we're excited about here at Sunrise. But, Brian, I think what I'd love to do is maybe use, kind of take a reflection point here and look back. We've done we've successfully had 3 funds through SEI Growth or through Sunrise Capital Investors. We launched our very first fund back in 2017. Man, it's crazy. It's that was six years ago. It seems like a lifetime ago. 6 years is sometimes a lifetime, but it was a long time ago, and we've learned a lot along the way. SEI Growth and Income Fund 1 and 2 they've been successful. They provided a full return of capital to all of our investor partners, and now have a infinite cash on cash return. Just literally enjoying the fruits of all the labors and infinite cash flow. It's a beautiful thing. And outside of that, just we were talking about this the other day as well. Just again, looking back, patting ourselves in the back, and that we've had 24 consecutive quarters of hitting our targeted distributions to our investors and our partners. I mean, if nothing else, if you take away everything else, that's something alone to be just super excited about and be proud of. So anyway, buddy, we've done this together as a team, and excited to talk about where we're going, but also reflect back on what we've done and all the great successes that we've had. So
no, I share the sentiment, man. It's been an unbelievable ride. I can't believe it. Snap your fingers, a decade goes by. It's absolutely crazy, right? Originally personal capital of friends and family, more formally a fund structure starting in 2017. Again, it's just unbelievable how time flies, right? But I share the sentiment. That last piece that you just dropped, right? 24 consecutive quarters of hitting targeted returns to investors. Probably the most important thing, most profound thing that we've done across over time, right? Because look, hey, the podcast is called Real Estate Investing for Cash Flow, right? Trying to help as many people as possible generate cash flow and build legacy wealth for them and their families, because that's what we're trying to do for our families. And we're going to try to help as many people as possible out along the way as we can. So again, it reminds me of Dan Sullivan, strategic coach, right? The gap in the game. As entrepreneurs, hard chargers, always grinding, pushing forward, A-type guys, you're always looking for what's next. There's always another mountain to climb. There will never be a situation where it's like we're satisfied, right? Proud, but never satisfied. And there's always another mountain to climb. But periodically, you need to stop and just reflect on what we've been able to achieve thus far. We're always chasing the horizon. We'll never get there, but it's nice to periodically stop, look back, golly, in a decade, we've been able to do some pretty amazing things, man. So kudos. It's phenomenal. It's been an amazing ride, and looking forward to the next step in the journey too, right? Exciting times ahead.
You went bald along the way. I'm going completely white. I've got this racing stripe in the front going on.
Salt and pepper, man. Chicks dig it, buddy. It's all good.
I don't know if you call that salt and pepper. It's more of I call it the racing stripe. But anyway, it's as long as the wifey enjoys it, and that's all that matters. But no, it's been a fun ride. So just for those that don't know, we actually opened. I'll speak more specifically to our last fund, that we just closed out here just a few months ago, which was SEI Growth and Income Fund 3. We actually opened that up back in October 2020, which is interesting because it was at a time, obviously during COVID. It was supposed to open a couple months prior, but everyone thought the world was going to end, right? And we know that did not happen. While we did see a lot of, there was a lot of challenges in many different capacities. We do know the world didn't end, and real estate really went on a boom cycle. But we opened that fund back in October of 2020, and over the lifetime of that fund, acquired 11 different assets, roughly equating to about $100 million in total assets. But part of our overall business philosophy is buying with a margin of safety. We've always and historically purchased assets below their current market value. I mean, that's just we like to have that margin of safety there, especially given the times that we're in today. It kind of reflects back on our business model. And while there's a lot of others that have they kind of bought into the craziness over the last couple of years. I'm not saying good deals weren't bought over the last couple of years, because we bought a lot of great deals over the last couple of years, but there's also a lot of assets that had overinflated values, and folks that just paid too much, right, and now find themselves in a precarious state. But we bought about $100 million in assets, and of those $100 million of assets, they've got a current appraised value of about $136 million, and so $36 million of sweat equity there in that third fund. With the last two deals that we just closed a couple of months ago, that we worked really hard to get closed. Again, lots of volatility in the market, interest rates all over the place, lenders, backing out left and right. But we got those things to the closing table. These were two institutional quality parks up in Columbus, Ohio, that we'd been working on for many, many months. And again, case in point of our business model. We paid $20 million for these two parks, and the portfolio of the two appraised that closing for $25.4 million. And that's before implementing our value add business plan. So again, it just really speaks to, what we do as an organization, how we look at, at our investments and our overall investment philosophy. And it's what we intend to do here moving forward. So, Brian, any thoughts there?
I would just say, that's a fundamental piece of what we do, right? It's the old Warren Buffett philosophy. Rule number one, don't lose money. Rule number two, don't forget rule number one. Warren Buffett's quoted as saying, right, the famous, most important three words of investing are margin of safety. So we try to, adhere to that investment philosophy. And I mean, this is a fundamental piece of what Kevin's all about, right? You've been doing this a long time, man, 20 years. And I think that the way that I try to explain this to partners and just folks in general about our business model and how we do what we do, it's that it's just built into your DNA to not overpay for anything. And I think it speaks to kind of your journey over time, right? Started from nothing in Pennsylvania, blue collar guy, ultimately built yourself up into a phenomenal situation by the time you were in your mid-20s, 125 single family homes, doing great. And then the Great Recession hit. Ultimately had to give some of those back to the bank. It hurt you really bad. Now you've kind of built yourself back up. Here we are again. And it's kind of the situation where it's been there, done that, got the t-shirt. We don't need to take outsized risk, right? We're just trying to buy really quality assets and hold on to them over extremely long periods of time to help as many people as possible generate cash flow and build legacy wealth in a tax efficient manner. A lot of guys are trying to chase the IRR over a 2 or 3 year horizon. And some of those crazy deals that got done, right? 2020, 2021, 2022, they're acquired leveraging kind of financial engineering to justify acquiring those assets, literally using terms that did not exist in 5,000 years, right? Interest rates were lowest in 5,000 years, and thinking that that's going to continue into perpetuity is just foolhardy, right? So anyway, we're just trying to, enjoy the ride over very long periods of time and allow that, decades of experience to help guide decision-making on the front end and buy with a margin of safety, et cetera. It's just something that's, I think, core, right, in our DNA at Sunrise, what we do and how we're able to do that, right? So anyway, all good stuff.
Yeah, no, I mean, it's interesting points that you brought up there, but just, really speaking back to the last 3 years, there were definitely, there were definitely points in time, where we had, internally, we had anxiety because we saw maybe a lot more activity going on by our peers within the same industry, right? Buying a lot of property, and us just being more slow and methodical with our approach. And only, we buy what makes sense and we pass on what doesn't make sense, right? And there's a lot of deals that maybe we passed on, others maybe they did make money on, but again, they just didn't have enough of that margin of safety that made us comfortable for XYZ reasons. And so again, now it's interesting sitting on the other side of the table. It's a really good seat on the other side of the table where we're at here today, and that, we're not losing sleep at night based on where our current portfolio and our holdings are. We're not over leveraged. We don't have debt maturities that are coming up. We don't have interest rate caps that are expiring. We haven't had to pause distributions to our partners, and it feels really good. It feels really good. And I think it's a really good layup to, to fund for of kind of where we're at today. We're ready, willing, and ready to start charging forward, continue to grow the business, grow the portfolio, and buy quality assets. And again, as I mentioned in the beginning of the show, we're seeing it already. We're already starting to see some pricing expectations get readjusted. We're starting to see some, maybe not necessarily forced sales, but just liquidation events happening, just to, free up some cash. Assets that might not have had a divestiture plan, today might have been years down the road, but partners or syndicators that are having to, or maybe wanting to sell now to free up some cash, and that presents opportunities for guys like us. Again, we're a fairly small group in the grand scheme of things, but it allows us to be really nimble. Move quickly, and and just to have a lot of fun while we're doing it. So, Brian, I think what would be fun to do is maybe, we kind of highlighted Fund 3 a little bit, but maybe you want to take a few moments and just talk a little bit more in depth, just I guess about our business model, but as it relates to maybe Fund 1, Fund 2. And I think it really helps build the entire picture of who we are as an organization.
Yeah. Speaking to the last point real quick, I agree, right? A lot of other shops are going to be pencils down right now, don't have the ability to really move forward. I think we're in a really, really good place based on the foundation that we've laid over the last several years. There's going to be some individuals that don't have the ability to take advantage of the next few quarters here, as we're in a very, very unique situation in the marketplace, because they're trying to get their house in order. Well, our house has been in order and it will continue to be in order. And for that reason, we can partake in a marketplace when a lot of folks, unfortunately, are pencils down. So, speaking to kind of how we've had our house in order, Funds 1 and 2, we've been very fortunate to return all that respective capital in a very, very reasonable period of time. From the beginning, right? Our mission is to try to help as many people as possible generate cash flow and build legacy wealth in a tax-efficient manner, because that's what we're trying to do for our families. So what we try to do is get folks to the infinite cash-on-cash return as quickly as possible. We just feel like that's the most efficient way to own and operate these assets, to try to drive the best risk-adjusted returns that we possibly can, to help all of our partners and all of our families basically create a snowball and snowball our wealth over long periods of time. So in Fund 1, we were very, very fortunate to help that investor, or help those investors get that full return of capital within the first 3 years. From that point forward, they retain their ownership in the funds and ultimately receive an infinite cash-on-cash return from that point forward. Fund 2, we were very, very fortunate to have that same exact thing occur. It took us 4 years to make that one happen. In Fund 3, we projected the same thing to occur somewhere between years 5 and 7. And we're, as we talked about earlier, right, well on our way to make that happen. So what about Fund 4? From our perspective, if it ain't broke, don't fix it. In advance of launching the fourth fund, what we always do before we launch any new respective opportunity, we always like to take a pulse from all of our partners, get an idea of how they're feeling. How do you feel about the marketplace? How do you feel about what we're currently doing? What do you like that we're doing? What do you dislike that we're doing? What can we do to serve you better? We're trying to do our best to provide white glove service to all of our partners. And we inquired about what are the main reasons that you ultimately have chosen to continue to invest with us over long periods of time. And of all the various reasons why folks choose to invest, whether it's cash flow, tax benefits, overall rate of return, growth, the number one thing was return of capital, ability to get the chips off the table and just implement that infinite cash-on-cash return model. So we're just leaning into that more thoroughly. And that speaks to kind of just the business model in a nutshell, right? Buy, improve, refinance, and hold. We've gone numerous examples of how we've gone full cycles on deals and generated good IRRs, et cetera, et cetera. But in our perspective, that's not the most optimal way to generate cash flow and build legacy wealth for you and your family. The most optimal way is to implement a buy, improve, refinance, and hold strategy in an asset class that has outsized same store NOI growth. And I would use the following example, right? We bought a couple of properties in 2017 in Maryland, right? As you're well aware, $2.6 million, great assets. Fast forward a couple of years after implementing the light value add plan, right? You're great at going finding deals off market direct to owner. We bought with a little nice margin of safety, same way we always do. We implemented the value add plan. Ultimately, fast forward a couple of years. In 2019, we had the cash out refinance on a property that appraised at $6.6 million. So it took it from 2.6, moved it up to 6.6. We're fortunate to do a cash out refinance, send all that capital back to investors in a non-taxable event. And then from that point forward, now we just enjoy infinite cash-on-cash returns. A lot of other sponsors, a lot of other guys, what they would have done is sold that asset, right? It was a phenomenal deal. We bought it for $2.6 million, basically invested about $1 million into the deal. We increased the value of the property $4 million. And a lot of guys at that time go ahead and sell the property. And it generates a ridiculous IRR. That's nothing wrong with that. That's great. But what happens when you hold on to the asset? Fast forward from 2019, 2020, 2021, 2022, fast forward to today. Now that asset's worth over $10 million. We still have a loan on the property, call it $3.5 million. And we're waiting for market conditions to justify going back to the bank, doing another cash out refinance, sending another chunk of capital back to investors in a non-taxable event. And in this manner, right, folks receive a quarterly cash flow distribution that's infinite cash on cash return, and then a periodic chunky distribution from cash out refinance proceeds over time, and don't have to pay the tax man along the way. So anyway, that's the business model in a nutshell. From our perspective, anything that we've ever done over time to change our business model has been done at the behest, has been done at the recommendation of our partners, right? And over time, we've come to realize, right, these short-term IRR-driven investments over 1, 2, 3 calendar years, nothing wrong with that. But those short-term fix and flip, it's nowhere near as good as building long-term assets and long-term wealth and asset classes that have exceedingly high quality, long-term same-store NOI growth. Just, again, fancy word for better compound interest over time, man. So that's why we love what we do. So, yep.
Well, I mean, also just another point to make there, more specific to mobile home parks, right? Like we know that it's an asset class that they're just not really building a lot of new inventory, right? There's very few times you hear about any new mobile home park that might be opening up or might be developed. RV parks different, luxury RV parks are very different, but your standard affordable living mobile home community, like what we own there in Maryland, those two parks being an example, they're not building them anymore. In fact, a lot of municipalities have a moratorium where like you can't build another one. In fact, these two respective properties, they're grandfathered in, the underlying zoning, if they were to be torn down, you would not be able to rebuild another mobile home park there. And so, it's very difficult. We could play the IRR game and chase those high IRRs. If we'd have sold, 2 years after we implemented that business plan, we would have, the IRR it would have been off the charts. It would have probably been 40 or 50%. It would have been a very massive win, but a very short-sighted win, right? And Brian's point is that, we can win many times over again. Why win once when you can win multiple times over and over the life of that investment, an investment that can't be replaced? So you sell that one property. Now you got to go find another one. You got to go find another mobile home park. And it's becoming inherently more difficult to do, to find good quality assets in good markets. Okay. Not just the asset, but also the marketplace itself. Salisbury, Maryland, where this property is located, it's one of the fastest growing cities in the US right now. And so again, just buying irreplaceable assets and phenomenal markets and implementing that, value add strategy, but also the tax-free cash out refinance over and over and over again over the lifetime of that asset. That's the strategy that we play, and that's a long-term game.
Yeah, love every bit of it, man. And I would say maybe we would chase the IRR if we were in an asset class that didn't have such exceedingly phenomenal long-term macroeconomic tailwinds, right? Like, our business model is in an asset class that will be in high demand for the foreseeable future. We provide affordable housing, the most unsubsidized affordable housing unsubsidized housing in the entire country. And that product will not go away for as far as the eye can see. Folks have been needing shelter forever, and they will need shelter for as far as the eye can see. And at our rung, the most affordable class of shelter, the demand for the product is high when times are good, and it's higher when we go through periods of recession. So it's one of these asset classes that I don't have to worry about 5, 10, 15, 20 years down the road ensuring that there's going to be a demand for affordable housing. It most assuredly is going to be there, which is why you can justify holding these assets over exceedingly long periods of time. And again, per Green Street, it's why they've got the highest long-term same-store NOI growth. It's just a beautiful business model, buddy. So anyway, we've both kind of built our entire lives around it, right? So anyway, no need to discuss it further, buddy. We love mobile home parks.
Yeah, you've gone as far, Brian. You've lived in a mobile home park, not just I mean, like literally, you've spent weeks and grinding away. And one of our first acquisitions together as a team. So no, I mean, it's we live and breathe this stuff. The point of that story is that we live and breathe this business. We really do. We absolutely love it, and I love being a part of it. So with that, what I would love to do, Brian, is maybe talk about Fund 4. I guess maybe more specifically, and we can dive into the. We'll give some details of the seed asset, which we're incredibly excited about. But more, I'm sure folks who might have that might be interested in either existing partners or new folks that might have an interest in partnering up with us, for Fund 4. I guess what's maybe different about Fund 4, than what we've done historically. Anything to speak of?
I would say, look, if it ain't broke, don't fix it. We're doing a lot of the same things, the same exact light value add business model that we've been implementing for the last decade. We're going to keep on ripping. If it ain't broke, don't fix it. But a couple of little tweaks we're making inside of the fund. We have a bonus for early adopters, right? So one of the things that our partners came back and suggested is that we provide a sliding scale for folks based on the time that they ultimately make an investment inside of the fund. rightfully so. So ultimately, historically, we've had basically a 70-30 split in the fund. You guys are familiar with syndications. We've had a 70-30 split. And inside of this upcoming fund, what we're doing for early adopters is providing a bonus that allows them to basically partake in some of the benefits of the general partner, some of the promote from the GP. So as opposed to a 70-30 split, that actually increases the earlier you make your investment inside of the fund. So suffice it to say, we're excited about launching that and allowing our partners to be able to partake kind of on our side of the table, on the GP side. It's a beautiful thing. The other piece I'd say maybe is just insight into tax benefits. Here we are in the fourth quarter. We get a ton of FAQs and questions from partners on what tax benefits might look like. Of course, we're neither CPAs nor attorneys, again, et cetera, all those various disclaimers. But our CPAs have provided us with a range of guidance of about 40 to 70 cents on the dollar. So if somebody invested $100,000, they could expect to receive in this respective calendar year somewhere between $40,000 and $70,000 as a passive loss in their K1 in the calendar year 2023. So those are some of the things that come to mind immediately when folks are, wanting to learn a little bit about Fund 4. But feel free to reach out to our team, guys. We're happy to answer any questions you have. But I'd love to dig in a little bit to the deals we have under contract, right? How about we start with this, pivoting the conversation. Most importantly, we have a phenomenal asset to ultimately kick off the fund as a seed property. Kev, you want to talk about that deal?
Yeah, and it's a big kickoff, literally speaking. Yeah, again, we gave some hints of the property we just tied up, and it's in Fort Wayne, Indiana, so the second largest city in Indiana. Tons of growth going on in Fort Wayne. It's in the northern part of the state. But this asset, again, gave you some hints in the beginning, but it's a 738 space mobile home park. So institutional size, institutional quality, actually institutional ownership property at this point in time. Again, speaking back to kind of our typical business plan is like a light value add model. So this particular park, it's already at a 90%. It's hovering right around 90% occupancy. And so very, very stable community, 90% occupancy, but with a great deal of upside in the existing lot rents. And so lots of room to run there on the market rents. It's got city utilities, newer inventory inside the community. So late vintage model homes. So this isn't one of those communities that's got, the old rundown junkers in it, old metal homes, metal boxes from like the 50s and 60s. This is a much more modern community that was built back in the late 70s and mid 80s. Majority of the tenant base there are resident-owned homes, and so very, very few rental units within the community. So lots of private ownership. Just speaking to the market itself, the Fort Wayne market is absolutely booming. The median home price is nearing $300,000. So there's a massive demand for affordable housing there. The majority of the mobile home communities in this marketplace hover right around a 93 and 94% occupancy. So incredibly strong occupancy. It just speaks to the need for affordable housing in that marketplace. So again, just incredibly excited about the opportunity. It's just a wonderful seed asset. And I think, again, I kind of pointed to this in the beginning. The most exciting part out of all those other points that I just shared is that we just had an appraisal performed by Colliers International, their manufactured housing group, which is one of the most renowned appraisers in our specific industry. And this park appraised at $5.4 million higher than what we have it under contract for. And that's before implementing the business plan. That's before doing anything. That's literally ground zero today, appraised for $5.4 million. And so just Brian, incredibly excited about the asset. Again, you probably couldn't pick a better seed deal for the launch of Fund 4. So not sure if you want to add anything there, but just excited to watch this one go down and be the kickoff of Fund 4.
I couldn't agree more. I mean, ultimately, everybody inside of the organization got extremely excited upon having that appraisal come back. It's just a beautiful thing to understand, and that the deals that we ultimately acquire, again, always wanting to ensure that we have a nice margin of safety immediately at acquisition, have a third party come in and verify that is indeed the case. Again, pedal to the metal. We'll push forward on this one and be extremely excited about sharing it with as many folks as possible. But that over $5 million of immediate sweat equity at acquisition, when we look at that compared to how much we're going to invest in the respective deal, it's basically the equivalent of a 20% return on equity day one, more than that, but more than 20% return on equity day one, without even implementing the business plan on the upside, right? Upon stabilization, it'll be worth more than that. Again, but don't take my word for it. Go check out the appraisal. We'll happy to pass it along to you guys if you have an interest in checking it out. But digging into a little bit further here on why we love the asset class. You talked to the market rents. I want to dig in a little bit further, okay? Because this I think is important for everybody to understand. In our industry, right, when you're looking at all the different folks that are kind of in the mobile home park sector and all the various business models, there's a lot of different types of business models that folks can implement inside of the mobile home park sector. Some guys like tenant-owned homes, some guys like park-owned homes because it generates higher rental income. Some folks focus their entire business model on infill, right? Buying assets that have 30, 40, 50% occupancy, bringing in a bunch of homes. Our business model is a light value add business model where there's kind of a few different tiers, levers that we can pull to drive value. One, finding assets that have below market rents. It's the easiest upside. Two, mid-grade upside, high hanging fruit, mid-grade fruit is operational inefficiency. Fixing all the broken pieces inside of the community already, right? Fixing the vacant homes, renovating those, getting those leased up, billing back for water, sewer, trash, all the stuff that's just traditional in all other asset classes. But in our crazy world of mobile home parks, people don't run properties efficiently for some reason. In any event, the high hanging fruit is that infill, as you well know, right? Bringing in brand new homes, new or used homes to infill those vacant lots. And that's kind of the high hanging fruit. It's the most difficult upside to achieve. And if you look across the industry, a lot of guys focus on that side and say, our value add plan is to bring in all these homes, this, that, and the other. We're really good at bringing in new homes. Our business model is to focus on the first two levers. It is to focus on buying deals that have below market rents and fix the operational inefficiency. And then if there is additional upside by virtue of implementing an infill program, then we'll do so. And that's how we really blow it out of the water. But the deal has to make sense by virtue of just buying below market rents and fixing operational inefficiency. And this deal, one of the things that we love about it, it's got woefully below market rents. Average lot rents inside of the community of $481. Current market rents are $574. And it's not pie in the sky. Maybe we'll be able to recapture that loss to lease and get up to the lot rent, the market rents in the vicinity. From our perspective, it's imminently achievable upside. When you look at any of the comparables in the vicinity, sometimes you don't know with absolute assurance in advance of acquiring a deal what the true market rent of your property is, because all those other mobile home parks, all those other properties that are comparables, they might have subtly different amenities, right? They might be on a different corner, different locations. Some might have pools, some might have better clubhouses, and all the various different nuances between mobile home park to mobile home park. But we know with assurance that we'll be able to get these up to the lot rent, the market rent, because we're already doing so. This is a 738 space mobile home park. Over 80 of the lots inside of the community are already rented at $574. It tells us that it is an inevitability that we'll be able to get the other lots up to the market value over time. It's not going to happen overnight, but we'll inevitably be able to recapture that loss to lease over time because we're already doing it. As those leases roll over, we'll be able to move that up over a period of time. There's no better comparable in the marketplace than your own respective asset. So from our perspective, that's imminently achievable, simple to achieve upside shortly after acquisition, in addition to that which we're already doing, which is buying with a nice margin of safety. So those are the things that I just love the most about this respective property, so, Kevin. So kudos on finding another diamond in the rough, buddy. Much appreciated.
Yeah, no, excited. No, it's a team sport here. So yeah, super excited to take it down and looking forward to to sharing in the opportunity with all of our partners that are going to join us for this journey. So yeah, I don't have anything else to add, Brian. I mean, again, I think that that sums it up quite well. Again, both the C deal, our overall investment philosophy, and just who we are as a group and individuals, and just really the sheer excitement that we have, again, not just for launch of Fund 4, but again, just speaking to what I feel is going to be a great opportunistic time here over the next year or two to buy additional great assets such as this one in Fort Wayne. So super excited, my friend, to watch us continuing moving forward.
I agree. Right now, there's a vacuum in the marketplace, right? The biggest guys in the world are sitting on the sidelines, pencils down. Some of the other guys, they're just trying to get their house in the order. Everybody's chasing the quarter. Again, we've had our house in order. I'm just looking forward to the next stage in the journey, buddy. It's going to be a fun ride, man. I'm looking forward to it.
Yeah, agreed, my friend. And for those that are listening in here that'd like to learn more about Fund 4 launch or the opportunity working with Brian and myself and the rest of the team here at Sunrise, you can head on over to investwithsunrise.com. There you can get access to our offering docs. You can get access to as Brian had mentioned, the appraisal of this particular deal that's going to be taken down that's going to be taken down into Fund 4. And again, all the other supporting docs associated with our business. And again, that's investwithsunrise.com. Brian, anything else to add before we wrap it up for the day?
Oh, we just love to jump on, talk shop. If you guys have any questions, feel free to reach out again. Investwithsunrise.com. We got a whole slew of stud investor relations associates who would be more than happy to jump on, answer any questions that you have. The fund is going live on November 14th, so very, very good. Feel free, guys, to reach out at your leisure. Again, we're providing some incentives for those earliest adopters. So feel free to reach out again, investor. Feel free to reach out again, investwithsunrise.com. And we look forward to hearing from you guys.
Alrighty, Brian, that was fun, man. Again, as I always say, we need to do this more often, but glad that you joined me here. It's always a ton of value when you come on the show, and looking forward to doing it again, my friend. So with that, we'll wrap it up here for the day. So guys, that's all we have for this week's show. So until we meet again next week, this is your host, Kevin Butt, wishing you huge success. Take care now.